Okay, I'm going to get started with my part so we've got a lot of content to get through today. So welcome everyone. For those who are here every week, welcome back. For those who are here just today, thank you for joining us. So my name's Angie. I manage the New Ventures BC competition presented by Innovate BC. This is our weekly startup seminar series. And today's topic is exit strategy. And you may wonder why we would be talking about exit strategy when you've just started your companies, but there are actually a lot of good things to know in advance so you can plan accordingly and think of certain considerations along the way. So we always like to talk about this topic as well in this series, just to kind of start that thought process going. So we have David Raffa here, who's joining us to talk you through the presentation. I'll pass the mic over to him momentarily, but first I'll just go through our general housekeeping slides. So again, we're towards the last 3 seminars in this startup seminar series. We will have another round of seminars probably September as well, but it's been a fun, I think, I don't know what, 12 or so weeks so far. So a couple more to go though. So if you are interested in these final 2 topics after this week, please join us. And we do have recordings of everything online as well. So New Ventures BC, we're a nonprofit here in BC, and our mandate is to support and recognize BC tech startups. We do that, of course, through the annual competition. For those in the competition, the scoring results are almost ready, so you'll get an email from me towards the end of this week. We also have an online mentorship program through our Venture Acceleration Program and our Sales Accelerator. So again, all these programs are listed on our website, newventuresbc.com. Just some community events happening upcoming. So later today is the VanTech Angel Forum meeting. Then there's a few other events up here. Tomorrow, Angel Forum is doing a DAO night. I think that's in partnership with another organization. And then also to note, June 28th is New Ventures also runs the helps run the Vancouver Vancouver Entrepreneurs Forum events, and they are doing a in-person only event actually this June on the future of transportation, and it'll be a big one at the convention center with lots of great speakers, and even a demo or display of a lot of some of the future transportation we've got. So I think that includes like Damon Motors, who has a electric motorcycle, and Lucid Motors, which is like a super fancy electric car. So definitely come check it out. We do have a few complimentary tickets with our promo code. So if that's of interest, feel free to DM me or email me after this, and I can hook you up on a first come first serve basis. Slides and videos are available. So I was just talking to David ahead of this event, and we will make his presentation slides available to you later today, where we've already got them. And you can access them off of our website. There's a seminars link off of our website. So please do access those. And I'm going to thank my sponsors, and then I'll hand it over. So our lead partner title sponsor is Innovate BC. Our gold sponsors are EY, Fasken, SFU Beauty School of Business, and the UBC Sutter School of Business. Silver sponsors, Ace Tech, TELUS Ventures, Output, VanTech, and Volition. And lots of wonderful bronze sponsors, service providers that are here to support tech startups like yourselves. And media sponsors who help tell your stories. So really lucky to have lots of great partners. Again, if you want to get in touch, here's the info. Otherwise, I will stop sharing so David Raffa can start sharing. So David Raffa gave this talk, I believe, for the first time last year, and we've had the exit topic a few times, but I really appreciated both the kind of the methodology towards how we presented exit, and also a lot of the information and considerations for startups. So really pleased to have David back to take you through this topic again. So over to you, David. Thanks again.
Thanks, Angie, and thanks, Liz. So, Angie, can you just let me know that you can hear me okay and see the screen okay?
Yeah, looks good.
That's great, thanks. So welcome, everybody, and thank you for accommodating the time change, doing a little bit earlier this morning, a bit different time zone. I've worked with startups my whole career, which is has been over 30 years, and one of the things I hear from a lot of startups right up front is I don't need to think about the exit. I'm worried about raising money and getting my company organized and all these other things. So I get it when you may be very focused on other things. I've tailored this presentation specifically to say, look, there's some things that you should know very early on that can be a big problem with your company down the road if you don't deal with them. And I'm going to give you some practical examples and some small tips on that. And then hopefully down the road, when you build your company up to sell it, you'll be well organized to do so. So by way of background, when I say that I've worked with startups, it's because I've been in the area my whole career, starting as a corporate finance lawyer, working with a lot of the startups in Vancouver, including companies that have gone on to do extremely well. I was the initial counsel for Flickr, which was Stuart Butterfield's company, who went on to found Slack. I was the initial counsel to Westport Innovations and a whole variety of other companies that started from 2 or 3 people walking in and saying they want to form a company to the outcome at the end of the day, whether going public or being sold. I was involved with a fund for about 10 years as one of the founding partners, so I was doing active investment, and I've been an angel investor myself. But the main thing that I'll bring to bear today that's relevant is that what I do now is advise early stage companies that are looking for an exit. And looking for an exit may be I'm looking for one, or it may be I've been approached and I need to consider how to deal with it. And when I say early stage companies, I mean sub 10 million in revenues, often not profitable because they're still raising money. So it's that experience which I like to apply to what I do. And I specialize with working with companies at that stage, so I understand them more intuitively. Okay, so I see the M&A process is kind of breaking down into 5 stages. They're not sequential. There's overlap between all of them. And between the 5 stages, they actually split into kind of 2. The first one's educate and analyze, which is actually part of the purpose of today's event, which is to help you educate yourself on this process so that you can approach it more intelligently down the road and do some things in the early term. And then the second stage, which is actually when you've made a decision to go to market, which is really 3 steps: prepare, market, and close. These 5 steps will form the framework for today's presentation, and I will go through all 5 of them sequentially like this, but the accent will be mostly on the first one, on education, to kind of give you as much information, hopefully, as possible that will be useful to you. Okay, so starting with education. So I'm not going to read the bullets out to you. I know it's a very boring way to do a presentation, and you will get this presentation. I've written it in a narrative form so you can read it afterwards. There are a lot of things to learn about this process before you go into it. And it kind of relates to a few things. One is if you're in a competition like New Ventures BC, it's because presumably you're going out to raise money, which means you're going to bring in outside investors, which means at some point in time, they're going to look for a liquidity event. And the kind of irony in this space is that entrepreneurs spend a lot of time learning about financing. I've done tons of financing presentations, and they should and they need to. But the single most important thing you will ever do with your business is sell it. Everything that you do up to then, how you raise money, who you hire, how you split up the equity, how you deal with the IP, how you go to market, how you define the product, how you do your sales and marketing, every single one of those operational and strategic steps, all is leading to one endpoint. And that endpoint is one that you will do once, which is when you sell the company. So you want to get it right. So the reason to educate yourself is so that you can get it right and you can optimize that process. And it's interesting because I run into lots of entrepreneurs who will have, say, an angel on their board or somebody on their board that they've added who has built and sold one company, okay? And that, by the way, that's a fantastic outcome to do because, as you know, lots of people don't make it that far. Most won't actually, but that's one data point. Yet on almost every other bit of advice they get, tax, legal, marketing, sales, IP, product, whatever, they are looking for as much data as they can to define their company. So it is very important for you to think about what you need to understand in this process. I'm going to go through each of these bullets you hear individually, so I won't speak to them now, but this is the reason why you want to educate yourself. You're going to do this once, you want to do it right. Okay, there's the previous slide talked a lot about kind of the high level concepts of what you need to know. Then there's some very practical things, and I'm going to talk about what some of those are. I'll give you a few examples right here on this slide about things that you should do today that don't cause you a problem down the road when you look to sell the company. Okay, and I will go through these bullets a little bit one by one because they're very important. At some point in time, you need to start preparing proper financial statements. If you don't, you'll find yourself in a lurch when you go to sell the company, and you might also find that you're restating your financial results because your statements haven't been done properly. When do you need to do this? Well, not the day you start, of course, but you should have a competent accountant when you start. And certainly once you get into revenues, when you're in the $1 to $2 million revenue range, you should be looking at doing audits. And if not audits, at least review engagement financial statements. They'll help you in financing efforts. They'll help you when you get to the stage of bank financing or mezz financing, and you'll definitely need them in a sale. Taxes. Here's a classic example of a problem I run into multiple times selling a company. Company's a software company. They're located in British Columbia. They're selling software all over Canada and the US. What they've been doing is paying their taxes in Canada. Sales GST when they need to, their income taxes, only to find out that they should have been paying sales taxes in the state of Texas, in the state of California, in the state of Florida. Buyer comes along to buy them and says, we think you owe hundreds of thousands of dollars of back taxes, and you're probably going to get penalized now if you get caught. We can't buy you unless this gets resolved. I had this exact example happen with a company that I got involved with, where I raised this issue with them. When I got involved and did the analysis, and we actually had to structure something into the deal to deal with it. And it was money off the deal that got escrowed for a long period of time. Corporate structure review. One of the things you'll go through in New Ventures BC is how to structure your capital. Very important. Often you start with 3 founders, 4 founders. 1 or 2 years down the road, somebody decides to leave, and making sure that they don't leave with too much equity in a situation like that, not applying vesting or whatever, could actually frustrate a sale down the road. Licenses and permits. Do you have all the ones that you need to do your business? Banks and approvals. You apply for grants. When you have those grants, you have to look closely at the language. Do they say you can't sell the company without our consent? And then the 2 big ones that are always a problem that I run into is intellectual property and employment contracts. You absolutely have to have these up front. I had a company that I sold that had been around for 15 years, and the buyer required the founders to go back and contact every single employee in the business who had ever worked on the code and get them to sign off that they had no interest in the code because they didn't have proper employment contracts in place up front. Another example where a company used one of the outsourced companies to develop their code, signed a contract with the company, a very well-known company, and the contract said very clearly that the code belongs to the client. But what happened was the contract ran to an end, and they had the work continue before they put in place a new contract. They didn't put in place a new contract for almost 6 months. The buyer stopped and said, we want to know which engineers in that company worked during that 6-month period on that code. We want you to find them and get them to agree that they don't have an interest in the code. This was an international company. This company was located in Poland. And they said, we don't even know who the individuals were. So these are the kinds of things that you want to be aware of very early on. And the one I could really point out to you here is make sure that you're using a proper employment contract right up front. Okay, let's talk about who actually buys companies. And I break them up into kind of 4 categories: strategics, consolidators, funds, institutional funds, and then what I loosely refer to as other, but it's primarily search funds and entrepreneurs. And I'll talk about each of these. Why does this matter? Well, this matters because when it comes time for you to present your company, you need to understand who the buyer is, what motivates that buyer to buy, and how you should approach them. The presentation that you give to a strategic is not the same presentation that you would give to a consolidator or a private equity fund. And so much like when you're dealing with selling your product to customers and saying, we want to qualify the customers and understand how they make their buy decision, you'll want to understand your buyers of your company to make sure you understand how they do their buying decisions so that you can make sure that you tailor your presentation to address their needs. So what are strategics? Well, strategics are the companies that are effectively in your space. And you've heard the term strategic valuation. And so this is a company that may do exactly the same thing that you do and is buying you because maybe you're doing it better or you're adding something to their technology or their product. It could be a company that's in the same space as you or orthogonal to you or collateral to you, or you can pick whatever algebraic term that you want. But for some reason, you're in a similar space. They're the one that's most likely to pay the highest price for you because acquiring you can be strategic to them. I've listed some of the reasons why here that they might want to buy you, and I'm sure you've all heard about the acqui-hire, which is they buy you because they want the personnel. But here's the real essence of what this is. As a young company, you can often sell for a very good value very early by virtue of having produced a very strong product that fills a gap in one of these big strategics. And when you hear about these great valuations, these strategic outcomes, that's where it came from. It came from that situation. And the pitch kind of goes like this. I, little company, have developed a great product, bootstrapping, and I know it's a great product because our customers love us. We have low churn, we have high customer satisfaction scores, we have a high net promoter score, and we've won a bunch of awards. You, big company, have some lethargic, overgrown code that you've been selling for way too long, and your clients complain constantly about it, and we can make your life a lot easier. And you have three things that we don't have, or 3 or 4 things we don't have. You have capital, you have marketing reach, you have brand, you have sales reach, you have distribution, which means you could take our product and accelerate our sales dramatically if you were to acquire us. And getting that message across to a strategic is what gets you a strategic valuation. Next on the list is consolidators and roll-up vehicles. And this one I love because if I were in the room with you and I could see you all and I asked you who the biggest software company or biggest technology company in Canada was, my guess is it's unlikely that you would actually name who they are, or certainly the biggest software company. And that company is Constellation Software. And they never invented any of their own software, but what they've done is they've acquired several hundred software companies. That's what they are. They are a consolidator. They go out and buy companies. Now, they don't typically pay the highest price to do it, but why they're a very good buyer is that they're in the business of acquiring companies. So when you're talking to a strategic, just like when you're talking to an investor, what you're battling with is that the person can say no because they're not compelled to do anything. An investor might say, I'll pass because another company will come along. A buyer, a strategic buyer may say, we'll pass because we don't actually have to do anything. They may have to do something, but they may say that. These companies are in the business of acquiring companies. That's what they do. So they want to get deals done. So again, understanding what motivates them and how they act is very important for approaching them. And I approach them on every deal, even though their valuations tend to be lower, because it sets the lower bar. And in many cases, if that's the only offer on the table, it at least gives you the option to say yes or no. Funds. My business has changed a lot in the last 5 to 10 years. It used to be that a lot of tech companies that I dealt with had funds invested in them, whether they were venture capital funds, VCs, or they were private equity funds, PE funds. But management was driving the process of acquiring companies. Nowadays, more often than not, I'm either talking to the fund, primary, and the management team of the buyer, secondary, or the two sets together. They are driving a lot of deals now. They see this as a way to grow companies that they invest in. And they buy companies in two situations. One is as a platform company, and that means one company that they're going to invest in, and then they're going to start to go out and acquire more companies to roll into it. You'll hear the term roll up. You see it referenced. That's what it means. A platform company needs to be fairly large. They'll typically want somebody that's already in the 25 to 50 million US revenue range in order to, and they'll invest in that company, and then they'll start to look for smaller companies to acquire. But they'll also acquire, and then they'll acquire smaller companies to tuck into. When you see the terms in the second bullet, tuck into or bolt onto are often used, these big portfolio companies. And these deals can be better valuations than the consolidators, maybe as much as the strategics, but typically a bit less, but because they are strategic to the fund to acquire you. Lastly, and especially if you're a smaller company, and by smaller company, I mean sub 20 million revenues, there's this concept called search funds. And there's other entrepreneurs who are doing a very similar thing. It's a very interesting idea. Basically, it's one or two entrepreneurs who successfully built and sold a business, who then get approached by 5 or 10 of the investors, maybe high net worth individuals, angels who are interested, and say, we'll back you if you go out and find a business to acquire. So they put together something called a search fund, which is really a bit of a misnomer because it's not a fund, it's a company. They want to buy your company. They want to move to wherever it is that you're located, and they want to take over the operation and own the company and run it. They may keep it forever as a cash flowing business and be a lifestyle business, or they may grow it and flip it down the road. But they'll buy companies for up to 20, 30, 40, 50 million dollars. And there's hundreds of these funds being formed all the time. There's a number in Vancouver. But they're all over North America. And if I talk to somebody in Dallas, they'll say, yep, no, if we find the right company, it's located in Victoria or Kelowna or Vancouver, we'll happily move up there to take over the company. And again, understanding who they are and how you pitch them is very important. Okay, key to the process. And there's a variety of people involved on both sides of the table here. The thing I want to highlight on this slide here is one of the big issues for you when you're in the process is who you let know that you're talking to a buyer that you're looking to sell. You don't typically want to tell everybody in your company for a bunch of reasons, which is many employees will get very, very skittish about that. They'll be very uncomfortable knowing it's happening. They'll start looking for another job. The other thing that can happen is you want to control the information flow and leaks going out. So it'll usually be a small team that you'll designate. But just as importantly, you'll also have to decide when you start to bring other people into the process, because buyers buying technology companies want to meet a lot of the people in those technology companies. And I had an example where the CEO did not want to bring in one of the VPs into the process, waited till they got to the point where they had signed a deal, and then brought the VP in the process. The VP said, who was critical to the deal, said, oh, I'm going to quit unless you give me X, Y, and Z. And effectively put the entire deal at hostage to demands because he realized the leverage he had. And that was managed poorly by the CEO and the board in that situation. So you want to be thinking about who in a company, would need to know, who in the company you want to involve in the process. Understand, of course, that it's always the founders, always the CEO and the CFO, and always the board that will be involved. On the buyer side, it's a similar group. Keep in mind, one thing that's important is they'll often have buy-side advisors working with them. And so as a result of that, you're dealing with somebody with that expertise. Okay, another slide I will spend a little time talking to is what can go wrong? Well, lots can go wrong, okay? And one of the benefits of the internet is now it's possible to get to every potential buyer that you want to get to that's out there. No matter who you are. I'm just a local guy in Vancouver who does this business. Yet I've been able to get to senior executives in Microsoft, Oracle, Apple, IBM, Zoom. I was just telling Angie before this, I did a Zoom call on Zoom with Zoom and the CEO of Zoom. And that's one of the benefits of technology. The flip side is nothing's nothing's private anymore. The moment your slide deck's out there or a teaser or something that you let somebody get a hold of, people can use it against you. Your competitors can use it against you. I had a situation where a salesperson who should not have known about the deal, knew about the deal, was pursuing a large partnership deal on behalf of the company I was selling. The deal would have been for $1.75 million. And sitting around having drinks one night while they was working through the long contract negotiation, this is a long sales cycle. This was like an 18-month sales cycle, happened to mention, because he wanted to show what he knew, that the company was considering a sale. And the partner said, that's it, we stopped discussions. We'll pick them up after you made a decision if you're sold or not. And of course, the CEO, the two founders of that company, the CEO and the CTO, went ballistic when they found out this happened. He wasn't supposed to say this. We ultimately repaired the damage associated with it. But this gets back to the prior bullet on who should know and also about what can go wrong. So your customers can, your competitors can be out there in the marketplace going, oh, I hear so-and-so is for sale. You shouldn't be doing business with you. Now, can you fully prevent all these things? No, you can't, because you can't stop people talking what's out there. But what you can do is, depending on how you manage it, is create a situation where you have plausible deniability and that you can control the narrative until the right time. The other big issue, same issue with your staff. Just like with your customers, you can have staff get wind of it and move too early. And so, the typical thing that I will get the founders to say is, when these things come up from your customers, partners, your staff, tell them that you've got investors. It's your job and your board's duty to always consider a sale. Everybody's always on the market in the sense that you get lots of inbounds, but there's no guarantee you'll do anything, and you're not necessarily actively marketing the company. And then bring them into the loop at the right period of time. And of course, one of the other things that's a problem is actually going through the process and not completing, which causes disruption to business, incurs a lot of expense. And I'm going to talk later about process, and having an actively managed process helps minimize the downside of these potential events. Okay. When you do M&A panels, so when you do financing panels, everybody says, what are the most important things to get a check from an investor? In an M&A panel, everybody wants to know, how do I get the highest price, maximize the valuation? So let me just kind of take you through a little bit of an idea. Okay, the simplest way a valuation is done is by what's called a financial multiple. And I'll give you a really simple example here, which is, revenues, a multiple of revenues, and what the valuation is. Okay. The multiple could be on revenues, profit, or normalized profit, EBITDA, or some combination of those things. If you're an early stage company and you're selling just for a financial multiple, it's not going to be a good outcome. It's not going to be a good outcome because, generally speaking, you're not profitable. And what you're doing is you've not yet realized the scale that you want to get to down the road, but you've been investing heavily in the business, which is going to allow somebody else to do those things. So you want to get out of that situation very quickly. So what are some of the other things, though, that you can point to talk about in addition to just what your revenues are when you're a younger company? Well, here's a whole bunch of them, and there's all kinds of them. There's geographical reach and vertical reach and awards you've received and new code versus old code, patents, a whole bunch of things. And your job in prepping is to go through all of these things so these things can be articulated to a buyer in addition to just handing them your financial statements and being stuck in a low-end financial multiple scenario. Let me give you an example of how types of metrics that can be looked at beyond just numbers and how they can affect evaluation when you approach it intelligently. Now, I'm going to apologize to people here who are not SaaS companies. I know New Ventures BC looks at all kinds of different startups. I work with a lot of software companies, so I use this example because this is kind of where I live and breathe. But what I'll tell you is there'll be a set of metrics in your vertical, just like there are for SaaS companies. So this is something that you'd want to learn and understand and start to track very early on in your process. So you have a long track record of showing the trend lines going up as you grow your company and be able to demonstrate those things, and also to be able to ensure that you're meeting the types of metrics that a buyer would want to see for the type of company that you are. Now, for SaaS companies, these are some of the most important ones. The type of revenues, of course, your margins, churn, I'm talking about there, losing customers, both in terms of number of customers and percentage of revenues. For those who haven't heard the term, LTV to CAC is lifetime value of the customer to customer acquisition cost. Do you have IP? And then there's this sort of funny one called the rule of 40. And that was invented because SaaS companies were often not profitable for a long period of time. And they weren't profitable because they'd taken their contracts and started to charge monthly what they used to charge up front. In the old days, you used to sell a license and get paid up front, and the license lasted for a year or 2 or 3. And then SaaS companies changed that to paying monthly. It was great for the business and cash flow, but what it actually meant was they were incurring expenses early and receiving the cash later, so they often weren't profitable. So the metric became, we want to see the number 40, and the number 40 is the combination of your annual growth and your cash flow. So if your cash flow is 0, it's neither positive or negative, then we want to see you growing at least 40% a year or more. If you're losing 20% a year, then we like to see you growing 60%. If you're losing 50% a year, we want to see you growing 90% year over year. Yeah, so the idea was to balance investment, which caused a loss, with driving top line growth and recognizing it. And then, of course, there's a whole bunch of other metrics you can see referenced there that apply. I'm going to give you an example of how this changes. So here's a typical client of mine. As I said, I typically deal with companies that are kind of under 10 million revenues or under 20, but mostly under 10. So let's say a company's doing $5 million in annual revenues and they're for sale. Okay. In their case, the 85% are recurring revenues, they're the SaaS revenues, but they have a launch fee. And they also end up doing some custom development work. And they are shipping a little piece of hardware, and they buy it and they do a sell through and they mark it up a little bit. Okay. So the revenue mix splits out like that: 85, 7.5, 5, and 2.5. I hope that adds up to 100%. Low churn. For enterprise software companies, less than 5% of both revenues and a number of customers annually is the target you want to look for, with an LTV to CAC of greater than 4. And the example I'm giving you, their rule of 40 number is very good. 65%. Their ACV is not bad. The sales cycle is not too bad. And some other things, good brand recognition. They're in every state and province in the country. These are important things. If you're a Canadian company, you're selling only in British Columbia, and you go to sell your company something in the US, they may discount that dramatically in the situation. If you're only in Canada, they'll discount it. So things that you want to know early on when you're making strategic decisions about where you're going to do your sales efforts. Okay, in this situation, with that revenue mix, we then go and say, we have a pretty good company here. We're going to apply a different multiple to each of these revenue streams. So the first example I gave you was 5 million revenues, 4x multiple, just a flat one, $20 million valuation. In this case, by understanding what you've got and your metrics, which justify a higher valuation, you're able to apply a higher one to the recurring revenues, but still get paid for the other revenues as well, which often get left out when you're negotiating, and you end up with a higher valuation in that situation. And if you don't address these things, the buyer will simply focus on your recurring revenues, tell you they're going to give you no credit for the other things, and you'll end up with a lower valuation than even my prior example, because it'd be 4 times $4.25 million. So it'd be 17 million versus 20. So these are the kinds of things about educating yourself in the process and understanding. Okay, but what about a strategic valuation? Well, you'll read online, you'll be looking up on one of the blogs and the tech feeds, and you'll be seeing, oh, somebody in our space sold for 23 times revenues. Let me tell you what happened in that situation. I can tell you that if you sell for 3, 4, 5, 6 times revenues, there's a financial multiple discussion going on. When you sell for that price, and I sold a company for 13.5 times revenues that was sub 5 million in revenues and was not profitable and had never been profitable, and we sold for 13.5 times. There was never any discussion of a multiple. The discussion was the pitch I gave you earlier. We, the selling company, have created a technology that's proven, accepted in the marketplace. It'll be purchased for the price we sell it at. We have low churn, we have high customer satisfaction. It does what it says it's supposed to do. People really like it. What we haven't been able to do is leverage it and really get into the high revenues because we don't have the bandwidth, the sales and marketing expertise, or the capital to do so. You, the buyer, can take that and plug that into your sales, marketing, and distribution channel and apply your brand and your resources to it. And instead of increasing revenues like we did last year by 50%, you'll increase them by 500%. In that situation, what you're doing is you're saying to the buyer, this acquisition is strategic to you, and we're going to allow you to earn a lot more from buying us than we could earn ourselves, and you're going to pay us for that. Now, they're not going to pay you for what they're going to do with your product, but they'll pay you more than a basic financial multiple. Okay? And why is it important for you to understand this? If you don't let them know that you understand this and you understand what you can do to their business, you will not get that valuation for it. What you're going to get is an offer that's financially based. And so, in other words, you need to simply let them know that you know what they know and you can see what they see. And you don't even need to be right about guessing about how much they can sell. You should model it out. That's what I typically do with the sellers, but it doesn't have to be exact. Okay, you just need to get the point across that you know. Okay, step 2, analyze. The issue here is, now, for a lot of you, you're thinking, well, I'm not thinking of selling my business right now, so it doesn't really matter to me. I'm going to talk to you about later on about why you do need to be prepared because of inbounds that will come in that may force you to consider selling earlier than you thought, and why you need to pay attention to that. But where you do actually decide that you want to go to market, the very first thing you need to do is actually look at the company the way a buyer would. And that means getting outside the company and looking in and identifying in advance all the gaps. Now, when you're out on the financing front, you're trying to show the best pitch possible to get an investor excited. You're not typically going to highlight gaps or weaknesses. You want to convince them, and they want to be convinced that you're the team that they should bet on, and you're the company they should bet on. When you do M&A, it's actually a different process, which is you may lay your gaps out, because you may use those to strategically discuss what the buyer brings to the table to fill those gaps. So beforehand, you want to understand what you have and what you don't have and what's missing, so you can come to the table sounding intelligent, because if they're buying you, they're going to want you to work together with them to make it a success. Now, of course, fixing lots of the gaps is going to improve your valuation. So I'll give you an example of a company that I sold several years ago. They came to me, they were doing $2.5 million in revenues. They said they wanted to try selling right then. I said there's a bunch of reasons why. I didn't think they were going to get a very good offer at that stage. I enumerated sort of 4 or 5. I said I thought the best that they could do was get an offer in the 3.5 to 4.5, 5 range. They said, well, can we test the market? I said, no problem. We put everything together. We went out, we tested the market. We had 3 offers. They were all in exactly the range that I'd given them. And all of the buyers cited the same things that I had cited as being the gaps in the business that resulted in making a lower offer. And what the buyers are doing in that situation is, yes, they're negotiating, but they're also doing this. They're saying, if we have to fix those gaps, and we think it's going to take a couple of years to cost $2 million, then that's part of the purchase price in our mind. So rather than give you 6.5, we're going to give you 4.5, and then we're going to invest $2 million. So the cost of this acquisition to us was 6.5. Well, The obvious thing for you to do is to try as much as possible, and it's not always possible, of course, because you may have limited capital, but to identify the gaps and address them to reduce that kind of discussion. And so, interestingly, after that, the company said to me, well, you kind of called it. Can you help us work on this? And because I work with earlier stage companies, I tend to go to the board meetings, and we put together a strategic plan, and we set objectives of achieving 5 milestones, and we went back to market when they were achieved, and we had 5 offers, all of which were above what they were looking for, and we ended up selling. When those early offers were about 1.5 times revenue, we ended up selling for 5.5 times revenue. And it did require raising some angel capital, but there was no institutional capital in it. It'd take several years to do, but it resulted in a much, much better outcome for the company. The big issue with so many small companies is they're not scalable and repeatable. Okay, and what they are is they're driven by the strength and force personality of the founders, and as noted here, the low-hanging fruit. So somebody comes up with a good idea, they've got some contacts who will be the first buyers. The founders are working ridiculous hours, 60, 70, 80, 90 hours of work, 90 hours of work. They're the best evangelists for the company. So they're the best, they're most likely to get a sale done. The problem is the way the company's built today is, in order for it to continue to grow revenues, it would need to add more and more people that of a like skill, and they'll never make money. So converting that business from that startup where you're flying by the seat of your pants into using processes, automation, tools like this to produce a scalable, repeatable business is critical. And this is something, one of the things that you'll see happen as you grow your company is lots of startups will actually get to the $1 to $2 million range, and then they'll never go further. They'll get stuck there and they can't get past $2.5 million revenues. You'll meet them 1 year at a financing forum, and 10 years later, they're still doing the same revenues, and they're break even, not making any money. And this is often the problem. I mean, the problem could be the market's not big enough or the product's not good enough, but it's often this. They have not converted the business into a scalable, repeatable. And why it matters when I'm marketing a company is when you present a forecast to the buyer, if they don't believe that you've got this in place, they won't believe your forecast. So they won't believe that pie in the sky forecast. And by the way, all of this stuff will apply when you have an investor looking at you. So the things I'm talking about have value when you're out there looking for investment. Okay, so what I tell every company, actually before they look for financing, but most importantly from my perspective, before they go to market, is to undertake a storyboard exercise. Okay, storyboarding was the concept of pitching a movie or a TV show to a network, where you would go in there and this is pre-slides, you would actually have boards on, you would have written or diagrams or visuals of 6 to 8 to 12 visuals to very quickly tell your story, to get the interest of the buyer. So it's equivalent to what you do now when you're going to a financing presentation. You do 12-slide PowerPoint or whatever tool that you want to use, okay? I believe that you should go through these things with your management team on an annual basis, because you'll be surprised how often people don't have the same answer to these questions, and ask and answer these questions. You need to understand them to make sure what you're doing makes sense, and that it's going to be successful, and that you don't have gaps, and that you're not wasting your time, okay? And I say that there's about 12.5 questions, but as you look at them, what you'll see is there's actually more than one question per question. So here's a handful of them, and here's another handful of them. They're all pretty obvious. There's no great science here. I'm not a genius that I thought of these, but it's amazing how often you'll see huge gaps in the business plan, the strategic plan of a company, because they're not thinking about these things. I want my clients, when I'm selling a company, to be able to answer all these questions, because every one of these questions will come up in diligence. Financing diligence is often less intense, but in a sale, it's very intense. And you need to be able to answer, because if you can't answer them, it's going to erode valuation. Okay, step 3, preparation. So you've educated yourself, you've done analysis, you've identified what you need to do to fix the business, and you want to start the preparation. This process can take anywhere from a month to 6 months. The earlier you start it in your company, the easier it'll be to do when you go to market, even if that's 5 years from now or 10 years from now. Okay. First of all, you're going to go through diligence, and it's going to be deep. The information you're producing in your company, the documents and the IP knowledge and the business knowledge and all of these kinds of things often isn't being captured early on in a business. If you capture this and put it into a data room starting from day 1, you'll be better able to get financed, and you'll be well positioned to sell the company down the road. And there's a lot of information that will get shared in a sale. You'll typically be working with a buyer for 3 or 4 months on diligence, and the more that you've documented, the less of your time it will suck up, which means the more time you can continue to spend on your business to make sure you're growing your business. I'm going to go through some of these core documents as we go, but what I want to show you is the types of topics that are going to get diligenced. So technical diligence, here's a very good example. So I had a situation where we had a buyer that was hot to buy our client, only for them to find out that the architecture we used and the tech stack we used was so incompatible with what they did that buying the company made no sense, because they were going to spend millions of dollars having to put the 2 tech stacks together, and it was going to take a long time, so they might as well just build it from scratch. Now, I'm pointing out something that caused the deal to fail, and you may think, well, why is that good? And the answer to that question is, in this business, in M&A, you want to get to a fast no. In financing, you're often trying to get the investor to fall in love with you over time by building up a relationship. But in M&A, the worst thing you can do is spend 4, 5, 6 months in a sale process only to find out it's not going to close. You'll have exposed your IP. Your employees will have been brought into it. By then, some of your clients and partners will have found out. So the faster you find out it's no, the better. So full transparency is what you want to do. You want them to buy you for the right reasons, and you don't want there to be a problem down the road. Okay. The last, on the right hand of the slide, the process, I'm actually going to go through the process as the last stage in this. So I'll talk about each of those items in more detail. But this gives you an idea about how much diligence you want to prepare for. And the thing I'm pointing out to you here is you're going to start generating all this stuff in your company from day 1. So starting to document it and organize it in a virtual virtual folder will save you a lot of trouble down the road. It will make diligence easier for your investors, your board, credit providers, and buyers. So for me, the core document, and the term you'll hear is CIM, which means Confidential Information Memorandum. It's much like an offering memorandum using a financing or a prospectus, but it's designed for an M&A, so it's written a different way. That document is not a business plan. It's written to market your company, just like you'd write marketing collaterals to market your product. And how you create that is by going through and answering the due diligence questions, the storyboard questions I talked about earlier on. I actually give clients a due diligence questionnaire that's about 50 questions long, and I ask them just to do 1 paragraph answers to each one in order to prepare the materials. All of these things, by the way, make you a better company, even if you don't sell, because they will cause you to examine your business, refine your thinking, and ensure everybody's on the same page. Then you have your basic plans. You'll often have a business plan, and you'll hear lots of people in the financing world say, oh, you don't need a business plan, it's a waste of time, don't do one. In the tech space, everything changes fast. It's true, but I'll tell you that with lots of investors, they'll want them. And certainly when you're selling the company, people want to know what it is that you're thinking. Importantly, strategic plans and any operational plans. One of the things that has value to a buyer in these situations is it de-risks the deal, which is they'll have documentation on how you operate and what your premises are, so that if they lose staff down the road because they don't stay with the company long term, they're not put at risk. And that's a big issue for a buyer. Big thing that I should tell you, this is one of the biggest problems that I saw in companies when I was a VC, is sales forecasts, financial forecasts not attached to a sales funnel. There was no science to them. They were just a made-up hockey stick. And as a result of that, something to start building from very early on. Start to understand your qualification process on sales leads, your conversion process, your sales time, and if you drop 100 leads in the top of the funnel, how much revenue it's going to produce and when, and have that built right into your financial forecast. Anything else that you present is just made up and will be treated that way by anybody who understands. I talked about making sure that you start very early on preparing proper financial statements. You don't want to have to go back and try to do this down the road. In fact, often going back to try to do an audit historically is problematic. And so you have to make the decision when to do it as you're coming forward. And if your forecast, what I like to do is have your CFO, once you get to the point where you're in revenues, $2 to $3 million of revenues, is have 3 forecasts prepared every year. One is your budget, which your board approves and everybody in the company is working to. But the second one is, if you're still in the stage where you're not profitable and you're raising capital, is preparing a break-even model. And why would you do this? You'll do this because the buyer might say, well, you're losing money and you got to raise money and there's no guarantee you'll get it. And if you do get it, it's going to be dilution. So we're only prepared to offer X. And what I like to do is to be able to trot out saying, well, we thought of that and we have a break-even model. So if we decided not to try to grow as fast as we're growing and not invest as much in the business, and we didn't want to raise money, or God forbid, something happened like a worldwide pandemic happened and all of a sudden the financing markets dried up, we can actually run break even by just making these changes and these assumptions. It wouldn't be how we'd want to run the business long term, but we're fine. That's ended the discussion that you've had with the buyer about trying to downgrade your valuation, thinking you're not profitable. Flip side is the growth model, which is, yeah, so here's our budget and we're trying to grow 35% this year. But if you were to buy us, or somebody were to buy us, or if somebody were to give us $2.5 million instead of the $500,000 we raised, here's how we could really grow what it would look like. And so having all of those 3 are weapons to use when you get out and you're negotiating your deal. I talked earlier about the performance metrics, gave you an example for a SaaS company, starting to track those for your space earlier on, understanding what they are and starting to record them will pay huge dividends down the road. Okay, and then there's some other materials too, which are kind of obvious, your cap table and the competitive analysis, knowing who the people are, and then update documents as you're going through the process. And so presentations. Presentations in the M&A world are very different than financing. You will never get asked to do a 12-slide or 2-minute or 5-minute or elevator pitch or anything like that. It's exactly the opposite. You'll do 2-hour sessions where they want deep, deep information. So I work with clients to build an inventory of usually around 100 slides that we can put in place in a logical order to tell the story of the business and present all the metrics. We will never actually present that. I mean, nobody's going to present a 100-slide presentation, although this one you got today is about 50. But you'll hand it over and they'll use it for diligence and they'll read it. What you will do, though, is you'll have a second version, and that'll be the presentation slide deck. And that will be shorter. It's not going to be 12 or 14 slides. It's going to be 30 or 35, and they're going to be detailed, but there'll be a summation of the much longer deck, and it should be able to present it in an hour to 90-minute session. And then you'll prepare a teaser, which is a short outreach document that is kind of your elevator pitch, just to start a discussion with potential buyers. The data room I talked about, which is finding for yourself a way of organizing all of the key assets in your company, which I mean documents and knowledge and things like that. Every contract you sign, all your employment contracts, all your partnering contracts, customer contracts, your IP, your assets, your code, your financials, all the plans that you have in your company, every press release, all your marketing documents. Starting to build that inventory from day one will be huge for you down the road. And all of this has value to a buyer, again, because it de-risks the process. Then the last set of materials on the right are all the materials that we would typically use together in selling the company. And I'll talk about when I get to the process stage. Okay, so we're 1 hour in, and I'm going to suggest just a 5-minute break, and we reconvene in 5 minutes, and then I'll take you through the last 2 stages. And we're 2/3 way through the business, so the time is good. So that's okay with everybody. Let's take 5 minutes, and then we'll come back to it, and we'll pick up with the next stage, which is going to market. And when I say go to market, I don't mean go to market as selling your product. I mean taking your company to market. So the last 2 things I'm going to talk about stages 4 and 5, which is go to market and then kind of completing the deal. So I talked a little bit about preparation. And, you know, of course, the question is when to go to market. And in your perfect world, you are going to control this process, and it is going to be well down the road for you. It won't be too soon. And you'll put together an exit plan based upon the things that you learn here and the things you learn elsewhere, educating yourself on the process, and you'll run an organized process to maximize the outcome. But one of the reasons why it's important to get ready early is often you end up having to sell your company, or it might make sense to sell your company before you thought you should. So here are some of the examples where that is. What you're going to find as soon as your company gets out there in the market and its product is being sold, you're going to start to receive unsolicited inbounds from private equity funds, from strategics, from consolidators asking if you're interested in selling. Most founders who I talk to, they brush these off. They say they're a waste of time, things like that. They're not. And they can be real. And often one of those buyers may have a strategic reason to acquire you. Now, they won't know typically how big you are as a private company. They'll have got your name somehow, and maybe you'll be too small for them to do it. But it is worth tracking them and starting relationships with them for down the road. There's other situations where your business is actually at risk, and here's a good one. So I worked with a company once where they had a very large partner that was responsible for a large portion of their revenues. The partner didn't buy from them. The partner worked with them and bundled their technology into the technology it sold, and then sold it to third parties. And so they were very dependent upon this partner. The partner realized how much value they were bringing to my client's business and finally said to them, look, we've been talking about this strategically. We've made a decision. We're going to buy you, or if we don't buy you or you don't want to be bought, then we're going to go a different direction. So they were forced into that discussion. Their revenues would have dropped 60% in that situation. So they were prepared. So we were able to have a conversation and get a very good outcome in that situation. Another one that pops up is a consolidation starts to happen in your space. And it's sort of like, there was a company in Vancouver called Layer 7. Actually, back when I was corporate counsel, that was another client of mine when I started working. And they were in a space where suddenly, and they were well venture funded and become a fairly decent sized company. They were in a situation where suddenly all of their competitors were being snapped up by the big logical buyers, and they realized that they were running out of buyers who might acquire them, and they ended up moving sooner than later and had a fantastic outcome. They sold for $140 million. So this is another reason why I'd be thinking about this fairly early on. So if you're forming an exit plan, which is your ideal situation, here's what you want to basically be thinking about, which is you want to get ready, but what you want to do is once you've gone through the prep stage, the analysis stage, done the gap analysis, you want to then methodically go to market, just like the way you would expect your sales team to do with your products, qualifying your buyers, understanding what their drivers are, prioritizing them, pitching them, nurturing them, and the most important one is the last bullet, which is, unlike selling your product, selling your company, you're only going to do once. So the way to get a great outcome is to have multiple parties bidding at the same time. You could only do that with a methodical process where they're all at the table at the same time. So having one buyer today, another 6 months from now, doesn't give you the ability to have one negotiate against the other. They have to know that they're in a competition right now, and it needs to be real. So what I tell companies is that you should actually develop, just like you develop plans for financing and for your product roadmap and everything else, you should have a exit plan and a deal process document where you've actually thought about how you're going to do this if it happens. So that you can ideally get buyers working to your process. And this is where we help to minimize the risk. Good example is access to the data room. I won't let any buyer access the full data room until we have a letter of intent, an LOI, in place and signed with them. So we decide on a core set of materials we're going to show them first, in order to find out if they're actually going to make an offer that's reasonable enough. If they're not going to make an offer that's reasonable enough, we don't want to be wasting time. Once they do, then they can have access to the rest of the materials. Otherwise, we want to protect the business and not give them access to everything. So I'm going to take you through the steps here. I'm going to go through once the entire process, and then I'm going to come back to the last half of it in the last section of this presentation. So let's say I were doing this. And by the way, if you're going to do this yourself, just substitute yourself for me, where it says investment banker, think founder or CEO or whatever. You start by doing about a one-page teaser and prioritizing all your targets and going to a short list, usually somewhere around 30 or so first, okay? In a long list, we might have hundreds, okay? When that teaser goes out, it goes out on a no names basis. So if you were doing, when I'm doing it, they'll see my email address, it's not a problem. If you're doing it, then you'd want to adopt a Gmail address or some Hotmail address or something like that, because you're not going to name the company in it right up front. And now, of course, once you give them your name, they can Google your name and then they'll find you on LinkedIn or whatever. They'll know who the company is. But typically what will happen at that stage, if I'm doing it, is the buyer will come back and say, I want to do one of two things. Send me an NDA and I'll sign it and I like the initial due diligence package, let's get going. Or they'll want an intro call to understand the process and those kinds of things, okay? Once the NDA is signed, and by the way, they're not like the ones that you'll often see in other situations. These ones are, my standard ones, about 8 pages long, because you really want to protect your business if you're talking to a competitor. You give them an initial core diligence package. This is not full access to the data room, but it's enough to allow them to assess the business. And then we start diligence. And we'll start with doing that presentation I talked about, usually a demo of the product. And then, of course, there'll be lots and lots of due diligence requests, some in writing, some in person, online sessions, whatever. They'll go on for months, or can go on for months. What you want to get is what I call a fully baked LOI, and I'll tell you what that means in a few minutes, before you give full access to the data room. And once you get signed that LOI, everybody else that you've been talking to is now frozen out because you'll be in lockup, okay? You want to see the valuation in there, but you want a number of other material terms. The most important thing, and this is another educational thing you need to understand, your deal is negotiated and cut at the LOI stage. It won't close on this, it'll close on formal documents. But this is when your deal has been settled, and here's why. Let's say in the LOI, they say, we'll acquire you for $15 million, and then we're going to start doing the formal documentation, we'll continue with due diligence. They'll never do due diligence and then come back and say, gee, we looked at your company and it's so great, we want to pay $5 million more for it. That's never going to happen. What it can happen, though, is say, well, we did the subsequent diligence, and what you represented to us in your presentation and your core package isn't exactly true. So we're not prepared to pay that. And now you've been in the process for 3, 4, 5 months with them. You've expended a whole bunch of money. You set the other buyers away, and you get trapped, and you end up selling the company for a reduced price. I will tell you, there's buyers who do this as a matter of practice. Being prepared and understanding what it means to be prepared run the process is being in a situation that you know when that LOI signed that everything you give them in the following due diligence is going to be backed up from what you told them. Sorry, everything you told them before will be backed up by the full data room. And so when I do a deal with them, I tell them, I say, here's the deal. You don't like it after the following due diligence, you can walk from the deal. Okay, but we're not going to negotiate down, because you're not going to find a single thing in there that isn't true, that makes something we told you before that's not true, okay? Legal starts, you go through the process. At some point in time, you do have to let your staff know. You got to figure out what you're going to do with them, who's going to stay, who's going to go, where they're going to go. and you close the deal. And then even closing, there's things that will happen after. There's what are called post-closing adjustments. They're a bit beyond the scope of this presentation, and there may even be ongoing payments over time. So what do you want to do if you go to market? Well, you know what? It's like anything in the world, the devil's in the details. And what you want is more than just a top valuation, because all the terms will matter. You want lots of offers because that's the best way to get a good price. You want them to be strategic. You want them clean offers, so with best terms, and you want to avoid risk of liability and negative adjustments. Okay, and then there's other things at the bottom, which is it may be very important to you. You might sell not to the highest buyer because you'll sell to a company where you think it's the best place for your staff to go, and who will maintain your brand and your product, and that will matter to you, especially if you go on to work with the company. So understanding all of these things when you go into the process and setting out your objectives is important. So you'll often hear at an M&A event, what is the best way to get the highest valuation? And the term that you will use is to get multiple offers. Actually, that's partly true. The best way to get the highest valuation is to have multiple offers, but be in a situation that you have the ability to say no to all of them, okay? And so now this is what pulls together everything I talked about before. When you present to a buyer business plans, strategic plans, marketing plans, sales plans, financing plans, a strong team, a vision of where you're going to go with the business, you're growing, you know where you're going to finance from, you don't blink when they say you're going to need to raise money. You're telling the buyer that if they don't offer you enough, you'll just keep going. You'll grow the business another year or two and it'll be worth that much more. The only way that's plausible is if you demonstrate to them in the diligence, you do know what you're doing. If they look at it and say it's filled with holes, these people don't know what they're doing, there's all kinds of gaps, they'll never raise money, they'll make a lower offer for you. If they think you're prepared to go forward, then they won't call your bluff in that situation, they'll up their offer. And so that's the reason why you want to get it right. Okay, last step, closing the deal. Okay, so closing the deal actually starts when you sign the letter of intent. And I like these to be as detailed as possible because for the reasons I told you, which is all the material terms are in here. And you should know that lots of deals do go off the rails between signing an LOI and closing. I don't know what the percentage is because it's a hard thing to pin down because people don't want to announce that they had a deal that went off the rails after an LOI. What I tell entrepreneurs is you must stay on top of the deal right till you close. When you sign the LOI, you can't breathe. It's just like in a financing. Financing, you get an agreement that they're going to invest. You stay on top of it until the closing occurs and you get the check or the wire transfer or whatever, and you don't stop until you do. Same thing in an M&A deal. Okay, now I said to you, I showed you the stages. I said I was going to come back to part of them. This is the latter half of the stages I showed you earlier, starting now with stage 7, where the LOI is negotiated and signed. Okay, and these are the things that happen that you need to be aware of. And at that process, at that point in the process, okay, there'll be more DD, and the legals will start, and the lawyers can fight on this, and that can be something you have to manage. You'll have to deal with your staff because at some point in time you will have to tell everybody, okay. And once you finally do close, you will have, as I said, post-closing adjustments and maybe even ongoing payments over time. So I can't stress enough, the deal and the valuation is set at the LOI. You want to make sure that you've got full visibility to what this deal looks like for you. All LOIs from a buyer will have a lockup clause in them, or what they call a no shop clause that'll say you must stop talking to other buyers at that point in time. So I talked about this idea of a fully baked LOI that's in detail. What does that mean? Well, here's what you want to cover. Obviously the purchase price, but are you getting it all on closing? Is there a holdback where some of it is held back and paid to you a year or two down the road? Do you have to earn some of it? In other words, based upon the performance of the company, okay? Is it cash? Is it stock? Is it a combination? What kind of price adjustment clauses in there? I did a deal where we negotiated a favorable working capital adjustment, and I'm going to show you an example of one in a second. And it netted our sellers $1.5 million more by virtue of the way we negotiated the working capital adjustment clause. Reps and warranties. This is much like you do in a financing, but in a financing, the company gives the reps and warranties to the investor. And if they're wrong, the investor sues the company. In the sale of a company, the founders and principals give them personally, because the buyer's going to buy the company. So there's no value in the buyer suing the company that it owns after the deal is done. It's going to sue you personally. And so again, making sure what you're telling them is correct is really important. Okay, they're not going to keep the staff. Who pays the severance costs? You may have an offer where the buyer doesn't need the staff because they've got a team, they just want the technology. They're going to want you to fire everybody the day before closing and bear all the severance costs. That could make a difference in your valuation to make that offer maybe lower than an offer that you received that was lower that didn't have that attached to it. So understanding these types of things are really important. So what do some of these things mean? Well, a holdback is, as an example, sold your company for $10 million. The buyer might say, we'd like a 15% holdback for 2 years. And what we wanted is a contingency fund that if some of the reps and warranties aren't true, rather than chase you directly, we've got a contingency fund that we can go collect the money out of. Vendor take back where they say we'd actually like you to finance the deal, which is we'd like you to take a note where we're going to pay you annually over some period of time, maybe with interest, so you're not getting all the money up front. And an earnout is where they actually say, okay, you've given us a forecast saying you did 5 million this year, you're going to do 10 next year, prove it. If you do 10 next year, we'll pay you another X. If you don't, we won't. And it may be negotiating that, and those terms will be very important as to the final total outcome for you in a deal. Now, I talked about the working capital adjustment. So typically on the closing of the deal, there'll be some kind of working capital adjustment to adjust the purchase price. And there's 2 scenarios. One is the most common scenario, benchmarking, and the second one is called zeroing out. And that was the one I negotiated in the one deal where we've got quite a bit. Okay, I'll take you through an example of what both of those mean. Okay, so actually, let me just go back a step, talk about it. Zeroing out the working capital is saying when we get to the closing, if there's any positive working capital left in the business above 0, we'll add it to the buyer will add it to the purchase price, and the sellers will get it. If it's negative, it'll be deducted from the purchase price. And so on closing, it has to be 0. And since it'll never be 0, there'll be some kind of adjustment made one way or the other. That's a simple way to do it, and is done in certain situations where the buyer doesn't need or care about the working capital in the business. And maybe where a seller has carried lots of working capital in the business to protect their business, and they don't feel it's appropriate for the buyer to get the benefit of all that cash. The more typical scenario, though, is the buyer says, okay, we'll pay you more if the working capital is high, or we'll deduct it if the working capital is low, but not based upon 0, based upon some threshold, some benchmark that we agree to. And that's usually some average of your working capital position over some period of time. Might be the average of the closing working capital over the prior 12 months, as an example, and negotiating these terms is very material to your ultimate outcome. Here's a zero-out example. Purchase price is $20 million. Current assets are $1.5 million. Current liabilities $750,000. Buyer gets $750,000 added to the purchase price, and now it's $20.75 million. The benchmark example, which is more common, purchase price is $20 million. Parties do an analysis and agree that the last 6 months, the average working capital at month end was $600,000. On closing, the current assets are $1.2 million. Current liabilities are $800,000. The working capital is $400,000. It's actually low. Happens to be a low month. So it's $200,000 below the benchmark. That's now deducted from the purchase price. This isn't about whether working capital is negative or positive. It's about whether it's above or below whatever benchmark's negotiated. These types of details are very important in your purchase price. And with that, that's my last slide. And so what I want to say to you to finish this up is whether you do it yourself or you hire somebody, you will only sell your company once. Not exactly true. Some people do sell it more than once, but that's a bit of an odd situation. You want to get it right. Everything you're doing is all about getting to this stage. Okay. And you want a good outcome. You deserve a good outcome in that situation. So you're going to have a copy of this presentation. You can look at my LinkedIn profile. You'll see copies of other presentations in there that will help you. Same on my website. And you can see my email address. Don't hesitate to reach out if you have a question posed. It's doing it virtually. It's tough to answer questions in the chat feature. I'm happy to answer a question in the email. If I can't answer, I might be able to point you to somebody who can. And I have lots of other collaterals that I'm happy to share with people that will educate you on some of these things. And with that, Angie, over to you.
Thanks again, David. Have a good day, everyone. Take care.